Welcome to Daily Wisdom from the Flippening podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor. Today's episode is taken from a 2018 conversation with Dhruv Bansal, co-founder and CEO of Unchained Capital, a company that provides cash loans to holders of crypto assets. We discuss what happens when the market tanks and shrinks a customer's collateral. For the full conversation, check out Flippening episode 8. This episode has two sponsors. The first sponsor is Nexo, which offers instant crypto credit lines. Check them out at nexo.io. Our second sponsor is the Nomics cryptocurrency market cap and data API for institutions, fintech apps, and funds. Without further ado, here's my conversation with Dhruv Bansal, co-founder and CEO of Unchained Capital. Enjoy.
The way we handle volatility is that we have a right to do collateral maintenance calls. Since we lend at a 50% loan to value ratio, you've got $100,000 of cash for putting $200,000 of Bitcoin with us. If the Bitcoin price were to collapse by 25% and it was to reach, let's say, $150,000, we would issue the maintenance request. We'd ask you to either repay some of the principal or provide more collateral, your choice. Nothing happens automatically.
Which one of those do you find people doing more often, giving more collateral?
Usually putting in more collateral. We're very careful, again, to ensure that customers aren't borrowing against the full amount of Bitcoin that they hold. And usually for us, that's a risk flag. And it's also just so much easier to deposit more collateral, right? I mean, our average time, it's an interesting statistic. There's been 2 major price drops since we've been lending that we've had to do this for. And our average time to get more collateral is about an hour, which is pretty incredible. In one case, a customer provided more collateral in 7 minutes.
Wow.
That's an amazing speed to recollateralize when...
Yeah, they're like, don't sell my Bitcoin.
Yeah, exactly. I mean, it's funny. Customers are so on top of the price motion that they'll call us the night before.
You're like, am I good?
They're like, hey, man, I think it's going to happen tomorrow. And we're like, all right, dude, chill out. That's cool. If it happens, it'll happen. We'll call you. It's going to be easy. It's actually been very nice how informed our borrowers are about the price and their obligations, which makes sense. They don't want to lose their Bitcoin.
So if it drops below, like if it depreciates more than 25%, then do they have to get back to?
I think contractually they have like 48 hours. And then if the price descends further to, I believe, a 45% price drop. So if that $200,000 in Bitcoin becomes, I believe, $110,000, if I did the math right, at that point, the loan is technically in default. And so we're allowed to repossess the collateral to pay for our principal obligations, liquidate it. And if there's any remainder, it goes back to the borrower. We're not allowed to keep any of it, and we don't intend to.
When they refresh their collateral, they need to get back to having 2x what they're borrowing. Is that correct?
That's usually the way we set it up. Though they're, of course, free to just repay some of the principal if they would prefer to do that.
What's the interest rate?
Typically, we're charging between 10 and 14%. Depends on the state and depends on the loan size and various other parameters. Oftentimes, we're constrained by the lending capital sources we have and the particular laws around lending in the states that we're active in. So we tend to just quote a broad range right there because it's a little bit too complicated to get more specific unless we really get into the particulars of each case. So we encourage borrowers, if that's a rate that you can tolerate, if you feel like that's fair for the liquidity that we're offering, get in touch. Let's find out if we can work together.
And is there a service fee or what other fees exist in addition to interest?
We charge a 1% origination fee, which is part of that 10 to 14% figure that I quoted previously. And most of the interest that we're charging is usually going back to our lending capital providers. I'll make a comment that if you think 10 to 14% is too high, you're a borrower and you're like, wow, that's a really high figure. I don't know if that makes sense. Trust me, I'm talking to the lending capital providers and they're telling me 10 to 14% is way too low. Like, isn't it? This is Bitcoin. It's risky. It should be way up here. And so it feels to me like we're not in control of the rates. That's just what the money markets, so to speak, are willing to lend at Bitcoin at. And demonstrably borrowers are borrowing at those rates. So I kind of feel like market dynamics have calculated the effective interest rate band. I mean, one thing I really like about having other competitors in market like Salt and a few others is that it's only going to act to decrease the rates to borrowers, which I'm a big fan of. I'm a Bitcoin holder. I want this to be cheaper for Bitcoin holders. As a company, I also think that being able to access lower cost capital for crypto as collateral is a great way for us to start being able to engineer new classes of financial instruments beyond just loans, which would require those low costs of capital. So 10 to 14% is where we're at right now, inclusive of all our fees.
Let's talk about future roadmaps. So when you think about, what's coming down the pike, it seems like there's different routes you can go down, a whole bunch of them, and you've thought about this a lot, I'm sure. Do you see yourself ever lending crypto assets in exchange for other crypto assets? In other words, if I want to sell my Bitcoin to get Ether, that can generate a taxable event. But if I take out a loan, it doesn't have to be a taxable event. Is that something you think you'll do? Or if you could just share with us your thoughts on future roadmap, that would be awesome.
Yeah, absolutely. Lending against Bitcoin as a form of collateral is sort of the zeroth and very first and laser focused place that we started. But you're right. Our ambition is to go, I think, quite a bit more broadly than that. Absolutely, we want to accept other forms of cryptocurrency as collateral. So we already have Ethereum working internally. We have a goal this quarter to do kind of a bug bounty around our Ethereum multi-sig contracts, which we're going to open source so folks can feel comfortable putting their Ethereum with us when they borrow. We anticipate having done Ethereum that will expand to ERC20 tokens and other kinds of assets as customers demand them. So there's sort of that direction in which we'd like to expand. I think what you're asking about is also really interesting. Instead of just doing crypto for cash loans, we could do crypto to crypto loans. And that's also really compelling and interesting for a certain class of customers. And it's a very natural extension past the product we're already delivering. But I would say that our ambitions, I think, are even more broad than that we're not Unchained lending because we don't view ourselves as truly just a lender.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username Nomics Finance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.